In today's video, we're going to continue with our investment appraisal unit chapter, and we're going to talk about the average rate of return. So average rate of return is another method how to judge whether an investment is worth for a company, for a business or not. So it measures the annual profitability of an investment as a percentage of the initial investment. So compared to payback method, it actually looks at the whole profitability of the entire project and doesn't necessarily take into account when the returns from the project are coming. How we calculate it, so this is the formula from our formula booklet. And sometimes the formulas that are presented in textbooks are a little bit different. They're a little shorter. So I'm going to try to explain the relationship between the two formulas that you might see. So we're going to use the formula booklet formula, but in some textbooks you might see this one. So the average annual profit divided by initial capital cost times 100, or even average annual net cash flow divided by initial capital cost times 100. So what is the relationship between the two? They all show the same thing. So if you think about the formula for profit, how do we calculate profit? Profit is total revenue minus total costs. So this is essentially what is shown here, at the beginning. In the formula booklet, when we calculate total returns minus the capital cost of an investment, we're basically calculating what will be the total profit of the whole investment. Then, if we divide it by the years of use, we are going to arrive at the average annual profit. Okay, so it all is pretty much the same thing. So you should decide whether you want to learn the formulas that are presented in textbooks, or if you would rather just rely on the formula that you will have during the exam in the formula booklet, so that you get used to using it, so that you know what information you should insert, what information you should maybe ignore, so that you don't get confused at the actual paper. I myself, from my own experience as a student, those several years ago when I was an IB business management student, I think I actually learned the textbook formula, and then at the actual exam I was pretty confused about how to use the formula from the formula booklet. So I just wanted to make a comment about the different formulas on this slide, so that you choose which formula you'll use, and then use it throughout your practice as well. Another thing that I want to mention is the relationship between profit and net cash flow. So the reason why some formulas show it ARR calculated as average annual net cash flow divided by initial capital cost, this is just a simplification. So we know from our previous units that profit does not equal cash flow or net cash flow, but in the investment appraisal unit, IB wants to simplify it for the students. So in this case, they're going to assume that the net cash flows actually equal profits, or that the average annual net cash flows equal average annual profits. But that's just for the investment appraisal unit. So to be honest, I would actually not work with this formula, because I personally find the formula in the formula booklet to be the most sure and to be the least confusing. Okay, so now that we know the formula that is presented in the formula booklet, what do we do with it? Let's take an example. So if a project costs $4 million and each year the project pays back $2 million, what is the ARR if after 4 years it will be given away for free? And By the project, we might mean some kind of copy machine, we might mean a car, or any unspecified project. That's not really important right now. Let's see how we would approach this problem or this example. So we need to highlight the different information that we get in the case study and try to apply it or insert the different values into the formula. So as you can see, I highlighted what information would count as the total returns. So we know that each year, for the period of 4 years, we will get back $2 million. So that would be our total returns. It would be 2 million times 4. So $8 million would be the total returns. Then another piece of information that we're given is the capital cost. The capital cost of the project is $4 million. Notice that in the formula, the capital cost appears in 2 places, above the line and below the line. So definitely remember to use it twice. Then the years of use. So for how long are we using the copy machine, or for how long is the project planned out for? It says in the case study that it's 4 years. So after 4 years, we want to know what will be the ARR. So then that is also shown in the formula. Now that we have all the information that we need, like basically taken out of the case study, we can insert the numbers into the formula. So how do we do that? ARR equals 2 times 4 minus 4 divided by the years of use, which is 4, and all of that divided by 4 again. Again, I'm using colors just to make sure that you know what numbers refer to which piece of information in the case study and as well in the formula. The final result would be that the ARR is 25%. Okay, so what do we do with that information? The average rate of return is 25%. We can use it to compare with some other information that the business has. So for example, we might compare 2 projects, or we might compare our ARR result with a criterion rate or level. So the criterion rate or level is defined as the minimum level set by management for investment appraisal results for a project to be accepted. Let's say that the management decides beforehand that the criterion level is going to be 20%. And so that means, what does that mean? Any projects that will yield the average rate of return higher than 20% will be accepted. Any projects that aren't as profitable, that will have an ARR of less than 20%, will not be accepted. So this is what our ARR results can be compared with. For example, we can also compare to other opportunities of investment for the business. Let's say that a bank will offer a deposit account with an interest rate of 10%. Which might be less risky, but on the other hand, also will yield less returns. And then it's up to the business to decide whether it will pick the project with 25% ARR, but maybe more risk, or whether it will deposit its funds on a deposit account where the ARR or where the interest rate is 10%. So this is what the result of ARR is used for. And let's have an example, or let's have a look at another example of how we can calculate it. This example that I gave here is super simple, super easy, but usually in the past papers, we're going to get an example which looks more like this. So in example 2, the project costs $1 million, and each year it pays back a different amount, which you can see in the table. What is the ARR if after 4 years it will be sold for $200,000? $1,000. So again, we use our formula from the formula booklet, and we should now try to decipher or basically tell which information goes where. I'm going to give you some time to think about it, and then we're going to go over it together. Okay? If you need more time, please pause the video. Otherwise, we're going to have a look at it. So, first, the total returns. In the table, the total returns would be all the positive cash flows that you see coming to the business from year 1 until year 4. The negative cash flow that we see here at the top in year 0 is the investment, is the capital cost, is the initial investment that the business made. So that will also be useful, but just to show you that we're not going to be using that number for the total returns. We need to differentiate between positive, let's say cash flows, net cash flows, and the first negative net cash flow, which represents the initial cost. And then the third piece of information that we need is the years of use. We can see it in the text that it's 4 years, but also in the table, the maximum years or the number of years is 4. So that is also a piece of information that we're going to insert into the formula. And then basically we just need to put the right numbers in. So the steps would be add up all the positive cash flows, subtract the cost of investment. That way we're going to arrive at the total profit. This is for those who would actually like to use the textbook formulas. Then divide the result by the lifespan of the project. So the number of years of use. This will help us arrive at the average annual profit. And then divide the results by the capital cost and then multiply by 100 to get the ARR. Yeah, to get the result in percent as a percentage in percent. So in this case, what would be the ARR? So my result was 10%. Okay, I have another third example ready for you. And in this case, all I'm going to give you for now is the formula. And again, try to calculate it yourself. I'm going to give you some time. Okay, if you're not ready, which is absolutely fine, I only gave you 10 seconds, then please pause the video because I'm going to show my working right now. So actually, I'm going to start with the numbers because most probably in the exam you're not going to have time to actually highlight with different colors the different pieces of information. So my results would be add up all the positive cash flows, so 2 plus 2 plus 2 plus 3 million minus 5 million, which is the capital cost, divide by 4, and then again divide by 5. If you want numbers, if you want colors, then here again we have a visual representation of the data and to show what goes where. The 5 million would be the capital cost. 4 is the number of years that we're using the machine for. And then again, we divide it by the capital cost. What would be the result? So for the ARR for this project would actually be 20%. And if we, let's say, compare this project to the one that we had previously, where the ARR was 10%, we can say that this project in example 3 would be more profitable. So as you can see, these both payback method and ARR are used as quantitative investment appraisal methods, and each of them has its advantages and disadvantages. So now let's have a look at the evaluation of the ARR method on its own. So what's good about this method is that it uses all of the cash flows. Okay, it actually focuses on profitability. So, I mean, that's good because most businesses, their central objective is to maximize profits. So it also doesn't take into consideration just the cash flows before payback happens, but also any cash flows that happen after payback. This is the result is super simple to understand. You can compare it easily with other projects, with other offers that the business gets, and it can be also easily compared against or assessed against the predetermined criterion rate of the business. Now, the disadvantages is that it actually absolutely ignores the timing of the cash flows. So as a result, if you have two projects that have similar ARR results, but one could pay back more quickly than the other, the ARR actually doesn't see the advantage of the project that actually pays more quickly than the other. So this is, for this reason, ARR is often used together with the payback method, because payback method shows you how fast you get your money back, your cash flows. And it's focused more on the liquidity of the project, whereas the ARR method is focusing on the profitability. So together, the two methods actually nicely complement each other. Another disadvantage of the ARR method is that all the cash flows are included. So the later cash flows, which are actually less likely to be accurate, are also incorporated into the calculation. And the same as payback method, ARR, its main disadvantage is that it actually ignores the time value of money. Yeah, the cash flows have not been discounted. They absolutely do not take into consideration inflation or any of these things. So this is the main disadvantage. If the exam asks you for a disadvantage of ARR or payback, the time value of money, the fact that these methods don't take that into consideration is going to be absolutely the right answer. Just don't forget to refer your answer to the case study, because that's why students lose a lot of points. Okay, so that's pretty much everything about the ARR method. What we also need to cover is the qualitative investment appraisal, because often in exams, students actually comment only on the quantitative investment appraisal, but they forget about anything else. So as we mentioned in the introduction to the unit or to the chapter, we or managers or the whole society needs to consider also other factors which are important when taking a decision about a project, not just the numerical quantitative information. So what would be the other qualitative information that we do take into account? We have to take into account the impact on the environment, on the local community, on other important stakeholders of the business. We might need to take into account some planning permissions, also definitely the aims and objectives of the business. Does the business even, is its primary objective to be maximizing profit? Maybe if it's a social enterprise, or if it's a non profit, not for profit organization, then maybe the quantitative investment appraisal methods aren't going to be as important as in the case of businesses who are trying to maximize profit. Also, another thing super important to take into consideration is the risk. Does the business want to take risks, or is it risk averse? So in this case, if, for example, you're um, reading the case study and you see that the manager or the CEO of the business doesn't like to take risks, maybe has having a bad feeling about the future, is not sure where the project is going to go, then in your essays you might actually mention that, because it's a super important factor we need to consider that when we decide about the project. So, a big exam tip, unless the question asks only for an analysis of numerical or quantitative factors, your answers to the investment appraisal questions should also include an assessment of qualitative factors. So don't forget that. Now, how to approach the qualitative investment appraisal? I mean, think about all the stakeholders, think about the use information from the case study. But if you want specific directions, specific instructions on how to actually approach this, then a suggestion coming from one of the textbooks that we are using is to use a mnemonic device, a Porsche. In some cases, I'm a fan of mnemonic devices, but in this case, I think that it's mostly about using your common sense. But let's have a look at what would be the different topics that you can cover. So the first letter P actually stands for predictions or gut feelings. It can be anything about the future, the intuition of changes in the future. What do we think? How do we think that the interest rates are going to change? Whether we think that there'll be a recession or won't. So we can comment on that and definitely include that in our essays. Second one, we already mentioned that, is the objectives of the business. So if it's a profit-seeking organization, then it's more likely to depend on quantitative appraisal, whereas an NGO will probably take qualitative appraisal into account more. Risk profile. Are the firms prone to risk or risk averse? What's the state of the economy? Are we confident that the economy is going to grow, or are firms scared or maybe tend to invest less at the period before, let's say, an anticipated recession? You can comment on that and definitely take that into consideration. What about the corporate image? So how will the investment affect the public relations or the corporate image in front of customers, the society, neighbors? Basically, you can comment on the effect on the stakeholders. Human relations. How will the change affect staff morale? So again, it's all coming back to how it affects stakeholders. In this case, the main stakeholder that it's going to affect is going to be your employees, your managers, maybe the public, and maybe the trade unions. And last one, exogenous shocks. So how are events such as hurricanes or oil crisis and other disasters likely? How could those affect your investment projects and so on? Use the mnemonic device if you want. If not, I suggest just use the different topics that we covered in Unit 1. That's exactly why stakeholders, objectives, the state of the economy, steeple analysis, why these chapters are usually covered at the beginning of the course, so that you can use it at the end, also connected to the new material that you learn. And the last topic, and this is just to somehow wrap it up, is to talk about the timing of cash flows. So this is partially already connected to higher level topic, but I want to cover it because I think it's very important that you actually realize it also for your future life, not just for the IB exam. And it's, what do investors prefer? And investors can be, even you eventually might be an investor. So think about this. Would you prefer receiving $1,000 today or $1,000 in a year? So the right answer, hopefully, is that you would prefer to get the $1,000 today. And the second question we can ask is, would we prefer $1,000 received today, or would we prefer $1,050 received in a year? Now here, we might already ask ourselves, okay, I'm not really sure what would be the inflation rate, what would be other factors, who am I getting the money from? Is it from a bank, or is it from an institution that is not likely to actually even pay me the money? So this is what the higher level students are going to cover. They're going to be discounting cash flows. So basically they'll be calculating present value of future money. For you, what I would like you to know or take out from this last part is that payment today is always preferred for 3 reasons. First of all, money can be spent immediately to receive the benefits from spending them. The $1,000 could be saved in a bank at the current rate of interest, and in a year's time, we will get back the same amount with interest on top. The cash today is certain, but the future cash offer is always open to uncertainty. So this is the 3 key pieces of information I want you to intake or consider. And this is exactly what we mean by taking the time value of money into consideration.